This conference will now be recorded.
Yeah. So whether you were talking about this,
Sir, I'm actually talking about the question that came for the test, sir.
related to the inflation rate,
Yes, sir.
just a moment. I'll just recheck with that.
I'm just not sure of the calculation, sir. That is the problem.
Asha, can you see my screen?
Yes, sir. It's this
Yeah,
question.
whether you are talking about this question.
Yes, sir.
Yeah. So this is what which we have it over there also. So that is inflation is nothing but the increase in the value. So from the year to year, there will be changes in the rates. So due to the market rate fluctuations, volatility in the market prices. So because of that, the increasal values for the next year onwards. So that it is taken as an inflation rate. So for example, so this was talked about the inflation rate where the figures are assumed for the driver cost and miscellaneous expenditures. So what is the percentage here it is showing?
15, sir.
15%. So if I want to increase the value, so if you see that it is going to be applied on maintenance expenses and driver cost. So this cost, whatever we calculated, it is 10% on the revenue value, what I have selected, I have calculated. So from the next year onwards, there is an increase of 15%. This is the inflation rate calculation. So how did we do this is equals to the previous year value into open the bracket 1 plus 15%. You can see the calculations over here. So the calculation it has to be done in this way.
Yes, sir.
Okay, the same answer here also it has been given. So the answer was this one. Okay,
Yes, sir.
yeah, thank you, ma'am. Yeah, is there anyone else?
And sir, I also have another doubt, sir.
Yeah,
What kind of a revenue is not recorded in the books of accounting, even though it is an income to us, sir? I think the options were membership fees and some subscription. I got very confused with that, sir.
okay. Once again, I'll just check it out.
And also, sir, I want to know what is the difference between membership and subscription.
Yeah, just a minute. Yeah, the question was related to when would a company collect a cash from a customer and not record it as a revenue? So
Yes,
it
sir.
is, yeah. So it is meant as like if you are going to take it as a subscription or membership, it is similar to that. Both are same only, membership as well as subscription. See, there are you can say it as subscription. Uh, Whatever the updates is there, so you will be able to receive it. So in any forms, either it is through a message or it could be you can be able to get it through an email. Okay, so regular updates what you are going to get it. So if you are a subscriber, you will be able to get it on online. So membership, it is like offline kind of getting registered. Okay, so but the both the activities are both are same. But why it is
Okay.
not being considered as a revenue? Because when you are going to take the subscription or a membership, you will be taking it for the multiple periods. So, for example, if you are going to join for a gym, so they don't take it as a monthly uh, fees. So they are going to take it as an annual fees. So where that annual fees, whatever they are going to take it, it does not being taken as a every month's income. The same value. Suppose if it is a 10,000 rupees, they take it as a uh, annual fees. So 10,000 cannot be the income of that particular month. So it is divided by 12. So whatever it is, the portion of amount comes over there. So that amount is considered as an income. The rest of the amount is considered as an unearned revenue.
Okay, sir.
So in that
Yeah.
case, the answer is all of them.
Okay, sir. Thank you, sir.
Okay. Yeah, welcome. So is there anyone else? So did I share it with the last time whatever we discussed about financial statement analysis? So that is preparing the income statement, then balance sheet as well as the cash flow statement. So have you people have referred that? So let me check it out.
That was easy, sir. We have.
So that you have been able to understand. The same thing. So you can be able to make it for a monthly wise also, so that you can divide it. In that we had one uh, point over there that we had been taken as a 5 years membership. So where we took the value for 1 year as our the current year's income, and the rest of the amount we took it as a unearned revenue. So if you remember, that is out of 65 lakhs, I think. The 5 lakhs was considered for that year, and remaining 60 lakhs was considered as a future revenue or unearned revenue. So you are all aware that the exam will be on Monday, right? Monday 6 o'clock.
Yes, sir.
Yes, sir.
Yeah. So please
Yes, sir.
once again share it in the group, or you can be able to discuss it with the people when you are meeting. So it will be there for a 1 hour, I think the exam will be. So you can be able to take up the exam in the similar way what we have been taken in the previous test paper what you have been attended. So it is similar to it. So you can be able to the aram, so you can be able to handle it. Only the thing is refer with all the concepts what we have been discussed till today, so that it will be helpful to you people. So and also see with those formulas what we have been discussed about when we were calculating with the change in values with current year's liability value minus the previous year liability value. The asset side, it is the present year, previous year minus current year value. So certain types of formulas have been given in the sessions. Please have a look on those parts. Is that everyone have understood with the EAI debt schedule calculation? So how to calculate with the EMI and the EAI values?
I didn't attend that session. I should check the recording.
Or is that? Okay.
Sir, can you please tell me which date that is so I can easily find that recording?
So we have been practiced on multiple sessions regarding this. We have been separately we have been discussed when we were doing with the balance sheet. Then we have also included in the Volvo model. So you can refer it, better to refer it with the Volvo model so that you can be able to get that.
Okay, sir.
Yeah,
Thank you.
you're welcome. So I'll just show you people that how you can be able to prepare that. So with an example. So the people who have attended, at least they can be able to help me out to get that values. Hope you people are able to see my screen.
Yes, sir.
Yeah. So can you people try this? So how to solve this? So you can try. You can tell me how the value to be calculated. So I'll give a 5 minutes of time.
So the end of the period will be 50 lakhs for year 0.
Yeah, good.
Then for year 1, BOP will be 50 lakhs.
Okay. So should I write the value?
No, so we have to connect the cell.
So we have to connect the previous year value, closing balance as our opening balance. Good.
Then we use the formula PMT for
Yeah, good. So the rate of interest, let me assume it as 15%. Then the period will be 4. Then
and the
PP
value
value
will be
50 lakhs
0, 0.
0, 0. Good. So this comes up to minus value. So what we are supposed to do is we have to change it to minus so that it will turn it into positive value. Yeah. And
Interest
this
expense
interest expense will be
on 50 lakhs, it will be 10%.
into 15%.
Principal repaid is EAI minus interest expense. Then end of the period is BOP minus principal repaid.
So the year 2 will be
Again, the ending balance.
so ending balance of 3 years.
The EAI will be the same for every year.
Yeah. So that will be okay.
And then we have to calculate 15% on year 2 amount BOP.
So that is 39 lakh 98,673 into 15%.
Principal repaid is EAI minus the interest. Ending of period is beginning of the period minus principal repaid.
So should I repeat it once again for the year 3?
So we can drag it or we can just press control.
So from which year onwards we can be able to drag it? Is it year 1 or year 2?
Year 1.
Yeah.
Year
So it was
1.
not. Yeah. It was not required to create with the year 2, but it was only for making people to understand that how to the calculation will happen. So we can be able to select this and we can be able to drag. So if you are properly calculated the first year, so if you drag it, it will be taken the year, the last period, the UOP date which is going to be turned into 0. Good. So hope Asha have been understood.
Yes, sir.
Yeah. Actually, I didn't see that who gave the answer, whether it was Nurel.
Yes, sir.
Oh, thank you. Fine. Let me find another question for you people. Okay, so we shall have a 5 minutes of break and we will just come back. So meanwhile, I'll just prepare one uh, kind of a question. So let's see how you can be able to solve it. So it has already we have been discussed about it. So once again, it could be a repetition to you people. Let me know how you have been practiced with that. Okay. So we shall have a 5 minutes of break.
Okay, sir.
Thank you all for being online. So hope you people are able to see my screen.
Yes, sir.
Yeah. So can you people let me know that how we can be able to calculate it? So which has an information about the income statement, so a simple income statement and the simple cash flow statement. So I think this can help you out to understand the inflation rate calculation also. Take a 5 minutes of time to understand this. Once again, have a look on all the values and which percentages, and then let me know. Okay, I just take this. So the commission, whatever we are going to earn it by selling this, the product A, it is going to be 25 rupees, and the drug B, it is 60 rupees. So for this, there is an increase of the price year on year percentage growth. So there is an increase of commission rate on 5% on the previous year value. So Asha, can you just get back to your question, what you had it? So can you try it and let me know what could be the answer? So how do I calculate the 5%
Same
increase?
formula?
Yes, ma'am.
Is it the same formula, sir?
Yeah. So wherever it
Yes.
says the increment or increase or inflation, so it is the
Yes.
same kind of a formula. Yes, go ahead, ma'am.
Okay. Then it is the principal amount, which is 25.
So equals to, I have to take the previous year
Yes.
value. Yes.
Open bracket.
Open bracket,
Then 5%.
5%.
Plus I forgot, sir.
Okay, no problem. Good, you tried. Fine. So
Okay.
you have to take the value of previous year as a common factor. Then you have to multiply. So you should use the multiplication symbol and then open the bracket. then give it as 1. That calculates the previous year value in the second year value, plus on that value there is an increment of 5%. So here two values will be added, the previous year 25 plus 5% increment of 25. So let me give it enter. So it has increased to 26 rupees. See, on 25 rupees 5%, so how much it comes? So let me just calculate it. So it comes to 1.25 value. So plus 25. So it has taken the rounded value as 26. Okay. So now if you take it the same calculation for the other years, so it will have an increment of, so 1.25 plus last year's 2.25. So it is more than 1.5. So it has taken 28, 29 and 30 value. So now the same thing calculation for the 60, the previous year value into, open the bracket, 1 plus 5% increment. So we are going to calculate the same for the further years. And here also it is 150 per packet and 100 per packet. Sorry, the quantity what it has been sold in that year, for a day it is calculated, since it is given here as per day calculation. So 150 per day volumes has been sold and 100 unit has been sold of product B. So here also there is an increment of 5%, that is previous year, open the bracket, 1 plus 5% increase. Same thing, previous year into, open the bracket, 1 plus 5% increase. Okay, so we can together drag it and we can bring it up the value. So the next, the annual sales, since this all the values we have been taken for the per day calculation. So here the same values. So quantity into rate. So we'll give you 1 day total sales value, but we want it for annual. So we are going to calculate it with 365 days. So that gives you 13,68,750. Same thing, we can bring it for the second one into this. And the total annual sales is, so this plus this will give you annual sales value. So this value what you are going to get it. So let me take this, drag this. So this is going to be the total annual sales value, the revenue for all the years. The next rent expenses, here it is expected to equals to 750 into 100. So this is 1 month rent, and this will be multiplied into 12 months. So it comes to 9 lakhs. So there is no any increment. So it is going to remain the same for all the months. I mean for all the years. Then there is an salary. So it is calculated as 80,000 per month. So equals to 80,000 into 12. Since it is monthly salary calculation value, so we have multiplied with 12 months. So this will be increment of 7%. So Asha, now can you try it?
Yes, sir.
Yeah, go ahead, ma.
Yes, so principal amount
Okay,
into
good.
open bracket
Yes.
1 plus
1 plus. So what is the increase percentage?
7, sir.
7%. It is not only 7, it is 7%. Good. You got this one. And so the same way, every year it is going to increase with 7%. Right. So other operating expenses. So if you go and check it out, it is set that 25% on the annual sales. So it will be equals to whatever the annual sales value is there on that into 20%. So like this, you drag it. Then interest expense, it will be equals to what is the loan amount we have it. So actually we had invested the money on this business on certain things. So we have been deposited certain amount before taking the place for the rent. So that is 10 lakhs. Yeah, so 10 lakhs. Then for the renovation purpose, we had 20 lakhs. We had invested for 20 lakhs. So the total of this investment value was 30 lakhs. Okay, and this 30 lakhs is been brought into the business. That's 30 lakhs into 60%. So it is 18 lakhs and 30 lakhs into 40%, 12 lakhs. So like this, you have a the interest rate is calculated on what value? With the given data, please let me know on what value do we calculate the interest expense. And there is no debt schedule is prepared for this. We are paying only the interest amount every year.
So it will be calculated on 8 lakhs.
18 lakhs. Very good. So equals to 18 lakhs. So that is the debt or loan amount what we have been taken into 12%. So and this remains the same for the years. So the PBT value will be equals to the sales value minus the sum of all the expenses. Which will give you this value and drag this. The next, the tax, it is going to be on this value into 55%. Then final value will be equals to the PBT value minus tax. So this is going to be our PAT value. Okay. So by keeping this value, try to create with the cash flow statement. So please write with the simple cash flow statement calculation.
So the initial investment will be 30 lakhs.
So here, whenever you prepare the cash flow statement, so it will talk about whether the money has come inside the business or gone out of the business. So you have to show the value, positive value, if the money comes in. If it goes out, so you have to show it as negative value. So whether the initial investment amount, whether to be taken as positive or negative.
Positives.
So positive means whether the money is coming into the business.
Yes, sir.
Initial investment amount,
The 30 lakhs.
30 lakhs. Can you see that how did we got that 30 lakhs amount?
The deposit and renovation.
So deposit is that any
Yes,
person is depositing in our company, or we are going to start the business and we are supposed to take a rent of shop. So for that, we are whether we are paying the deposit.
we are paying the deposit. So
So the amount is going out or coming into the business.
out
It is
the
going
outflow.
out. Yeah. So even the renovation. So when you are going to do a renovation, so you have to spend the money. So spending the money means you are taking out of your pocket. So again, it is an outflow. So the total investment amount what you have it is
Negative 30 lakhs.
negative 30 lakhs. Good. Hope others are able to understand with this. So I thought did I gave an extra zero? I think I gave. Yeah. Now it is. So the next thing is debt raised and repaid. So how much debt did I raise it?
18 lakhs.
18 lakhs. Whether the money is coming in or going out in the year zero. Initially, the loan, if you take it, the money comes in or it goes out.
It comes in, sir.
So it is positive value. So it is 18 lakh. Yeah. So what we received as a loan, the same amount was being paid back in the year 5. Here it is 18 lakh minus. Okay. The amount what you received it, you are supposed to pay it back because it is a loan. So the next thing is deposit refund. So after the period, you are going to get back your deposited amount. So how much amount we received?
10 lakhs.
10 lakhs in positive. Yeah. So then finally it is PAT value equals the profit after tax value from income statement. So let me go. So finally, we are going to sum it up. So when you are summing it up, do not take into consideration of only those value which has a only those cell values which is filled up. Select all the cell values, even if there's a blank, because we are going to drag this. So it has to reach all the values till the end of the table. Now, by keeping this total cash flow, we are going to calculate the IRR equals to IRR and select all the values of a cash flow statement and check it out. So it comes 32%. So it was being expected at least 20% if it comes. So we can go ahead with this business. So it is more than what you are expecting with this values. So it is recommended to go ahead with this business model. So financial model and valuation is meant for this purpose, to analyze with the history of the data and project it for the future data, and then we are going to come to a conclusion that whether we have to take the decision on this to go or not. Okay, so hope you people have been understood and enjoyed the sessions. So sorry if I made you people to get bored. So and also you people have been responded and taken some initiatives, and you have been shared the screen and you have been worked on it. I understand you people were very much busy scheduled classes were going on, but still you people have been cooperated. Thank you for all the support. So hope we are going to meet up any other occasion. All the very best for your exams. Thank you. Have a nice day.
Thank you, sir.
Thank you.